Indiacharts publishes Nifty Daily, daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Hi everyone, this is the 26th of November 2020 and I'm really pleased to bring you a detailed discussion into a particular intermarket relationship. And the reason I'm getting into this is rather than, discuss what I've already spoken about in the media the last couple of days, that is the relationship between what happens in your options market, that is the put call ratio, and also looking at the net call put difference, that is the actual open interest outstanding for puts over calls. So what we saw in the last 1 month was huge put writing, which is why even though the market started to look overbought, they continued to extend on the upside, which is what happens. And then you really need to wait for expiration. That's what I said day before on CNBC also, that plus or minus 1 day of expiration is where the market reaction may start getting visible. And then it's only after that that you really see some cooling off or some reversal. Now, it's still not happened in terms of a sharp reversal. You got a 1 day knockoff and then you got a almost 61.8% retracement today. But apart from that, the other observation was, of course, the FII positioning, which had reached near the levels where at least the last 2 or 3 tops have occurred in the recent past, the last year or so. And so these were 2 important observations, but there are others. And today what I'm really going to discuss with you is a third one. Now, if you want to look at the charts of whatever data I just spoke about, then the first thing you should do is download the Indiacharts app, and I've posted them under the long short updates. That's where I put out my sentiment indicators, and also there's a strategy update part where, in between, whenever the indicators get elevated, even though I'm not writing the detailed report, I usually write about those to give an update on, whether something's getting overbought or oversold. So you can read that there. But what we look at today is the intermarket relationship between the USDINR and the Nifty. And that's really interesting because for almost 2 months now, we've had a divergence between the two. So let's get right into that. We're looking at the charts of the Nifty and USDINR, and we're going to do some intermarket analysis. As always, something that's very, very interesting, especially when these divergences go beyond being just short-term divergences that last for a couple of days into divergences that are multi-week long. So we'll just look at what is happening right now and also at past instances in terms of what we could have figured out. So initially when this happened and when I was forecasting that the Nifty was going to go towards 12,000, then 12,500 and then 12,800, what I would have thought is that the USDINR itself would have fallen below what is the 20-month average at around 70 to 40, and it would have, or 70 to 20, somewhere in that range, and it would have gone much lower than that towards 71. But what actually ended up happening is each time that we've seen this rally, like the one that we got between September and October, the USDINR did come down, but it did not go below the low that we made in September. So in other words, from high to high, when we actually look at this entire pattern from high to high, then the higher high in the Nifty should have led to a lower low in the USDINR. So even at that time, I thought, well, fine, it may be one instance. Eventually, we're going to head lower. And then what ended up happening is the USDINR actually bounced back up. It went to the retracement, almost 61% of this last leg, which is also fair from where you should start anticipating that it heads down, which it has a bit. But what it has not done is that despite the new highs that we are seeing in the Nifty, we haven't really seen new lows in the USDINR. So essentially, it's become a now more than a 2-month, or I can almost say by next week, it's a 3-month divergence between the currency pair and the index itself. Now, can these divergences really last for very, very long? That's the moot question. And what do they really tell us? Because once it's gone on for very long, one of the two has to break away. Either the market just keeps going up and the INR starts getting stronger and the USDINR actually dips like it should to a much lower level, or else we have a setup where it's telling us that there's a trend change coming up. So looking at previous instances, you do get divergences between the currency and the index many times, especially at turning points, like we can see here at the bottom in March. After you saw the bottom and the market started making higher highs and higher lows, the USDINR was still going up, which means the rupee was still weakening for a while before it actually joined the market on the way up. So the bottom, or rather the top for the USDINR actually occurred on 22nd of April, even though the bottom for the market was the 24th of March. So it's almost a 1 month divergence between the two that occurred before the two really aligned in moving in opposite directions, which is the normal inverse correlation between the USDINR and Nifty long term, right? So when the USDINR goes up, the market usually falls. When the USDINR goes down, the market usually goes up. It's the points where this doesn't happen, where a higher high and a higher low in one contract versus the other doesn't happen, is when we start looking for potential divergences and the chances of a trend reversal. So what did we get in, say, Jan 2020? Again, it was a different setup, but when you actually zoom into it, and so if we just look at Nifty, we got a higher high here into the month of December. What happened to the USDINR? Almost flat. So you would have thought, fell, it's flat, it's okay, it doesn't matter, even market's not gone up so much. Made one more higher high, and at that point of time, the USDINR actually made a higher bottom rather than making a lower bottom. So again, you started developing a divergence ahead of this entire structure, and that was sort of forewarning the USDINR wants to go the other way. And if it wants to go the other way, why is it doing so? Does it really have a market impact, is what you had to start thinking about. The actual market impact, though, in a significant way came more than a month later, though this is where both of them topped out and we actually got a reversal. The big move came almost a month later. Okay, so this will happen over and over again, and sometimes it will happen over several months, slowly blending the change. Like you see here, the higher high in the market, you got a lower low in the USDINR, and then when it rallied into, and this is the election period 2019, right? This is the election spike, and then this is where the budget occurred, and so this is the top. And when you actually reach that point, the USDINR did not really make a lower low. Okay, so while you made a higher high, you had the budget, and the budget time, the Nifty started rolling over, made a lower bottom, and that time the USDINR actually made slightly higher, you can say a near double bottom case, and so this was really turning, and then you got the turn in the market and the currency pair itself. So these divergences exist. There's short, very, very short periods of time where it may look like both of them are going up or going down together. Okay, it doesn't always happen. Very, very short. This was probably one of the longer periods where that happened. But the real divergence is at the fag end, where you actually see that the Nifty peaked ahead of the currency pair, which is here. Okay, and then the currency pair was still going down along with the market. So this is where the divergence was actually before that, which means that this was a divergence, right? So the market was going higher, but the USDINR had stopped going down, so in fact it was not even going down prior to that. So this was one of the most, this was the only period I think I've seen in more than 10 years where the two actually appear to go in the same direction. If you slightly zoom out and look at between April and August, it will look like both are going up. Okay, and so it was a more like a change in the relationship itself rather than even calling it an intermarket divergence. But most of the other occasions, if I simply go back again and again, we can find either a very short term or slightly more medium term divergence between the two at the fag end of a move. So this is 2018, the 2018 top from where the US market has also crashed very sharply, and so had India from Jan all the way into March. And just before that happened, in the last part of the rally, the USDINR actually did not make lower lows while the Nifty was doing so. So this intermarket divergence forewarned of such an outcome. Now somewhere, where can we find much more similar outcomes like the one that we are seeing right now, like the one we saw in January? You can actually go back even as far as say 2005 to 2006. So let's actually look at this period. Okay, so that's the previous that's the previous bull run that was going on. Okay, and so this is in the midst of a bull market. So when you're in the midst of a bull market as well, these divergences can go on for even longer. Okay, so as the market continued to make higher highs till this point of time, the USDINR was getting strong, and then as we continued to make higher highs, we were not doing so in the currency pair. This happened from one top to the second top, and then from the second top to the third top, and eventually the two diverged, and you ended up getting the market correction. So you have to watch for the point where it really happens. Okay, and So sometimes I have actually found that it's the third wave. So if you actually look at this in terms of wave sense, it will be the first wave, there would be a pullback, consolidation, and then when the third wave actually occurs is when you have a market related impact. Not necessarily always the case, but generally speaking, that's what I noted back then. And you could even see that here between the Feb-March period, it was basing out. It made a first advance. In this first advance, you're actually not seeing the higher highs in the market lead to lower lows in the USDINR. So you actually had a divergence here. And then finally, you saw market impact. You saw market impact after this point. Okay. And so that's when the rising USDINR caused the market to actually come down. So you can say that was the third wave in terms of advance from this bottom 1, 2, 3. And then you had a market impact. Now, of course, later on, you had a reverse divergence where, the market is making a higher bottom and the USDINR is also making a higher high, and that's where the divergence became reverse of what it was at the bottoms. And then eventually the market headed higher and the currency pair headed lower, the normal inverse correlation that we expect from the two. So whenever we see these divergences, they essentially forewarning us of a reversal. And a reversal means, so sometimes people ask me, when do we know it's a positive or negative divergence? It's a function of what was the trend prior to the divergence. Okay, so prior to this divergence, what is the trend of the market? The trend of the market was up. And so when the divergence occurred, it's of course a forewarning that you could be heading into a period where a reversal can happen. And then of course you need to actually wait for the market to give you that reversal signal in terms of momentum indicators or trend line breaks, whatever you're using. But you have a forewarning. And similarly here, where the divergence was occurring, it was after the market had crashed. This crash here, it may visually look small. It's a 30% fall within 1.5 months in the Nifty in 2006. Some people who've been around long will remember that crash. It was almost overnight. A lot of derivative writers, option writers, got stuck because of overnight gaps during that crash. So that's how significant it was. And so the same applies here as well. The preceding trend was up. Moment you got this divergence, it was a forewarning of a turning point coming up to the other side. And so that's what we are facing today. We are facing today a divergence that follows what has almost been a 6 month or 8 to 9 month long rally from March all the way into October, November. And we now have a 2 month divergence between these two, which you can almost say, if I take this as the first wave, then you've had the first wave of divergence. It's the third wave. If the USDINR actually turns up from here and starts moving higher, then it would be the third wave up for the currency pair. And in that scenario, I guess it may be getting very, very close to the point where it can start having a market impact. So far, it hasn't had it. But as history shows, that at some point of time, these divergences kick in. One of the two has to go wrong. Either USDINR continues to break down, which if it does, then of course we have a completely different scenario, which is extremely bullish for the markets itself. But if it does turn from here, then you should pay very, very close attention to what the index itself is doing. And if your index indicators start giving you sell signals, you should probably not ignore them.